I know many of you, track news and related to M&A, companies being acquired and disposed, which are announced in public. And many of you would be also intrigued to know how deals are executed or what it takes to get to a transaction. So I would endeavor today to touch upon some of these, key steps in the life cycle of a merger and acquisition. And also by virtue of this conversation, I would also be talking about the various roles that exist in this field. And someone who is interested to explore a career in an M&A role, what it takes, what are the skill sets that are required to perform various activities that happen in M&A. So I would also extend my warm wishes to coordinate this session and getting this organized for the Indo-Canadian professional community. So let's get going. Um, I would like to encourage participation from you all, and that's how generally I run sessions. So feel free to contribute and interact and make it a little more interactive. We would obviously be having this session covered in two volumes. First volume of which is being discussed today, and we will have or hold a live session for the second volume of it somewhere in early November. So let's get going. I will be sharing my screen. Udit, just let me know if you're able to see the screen when I share it.
Please.
So let's start with buy-side activities in a transaction, and let's have an example of a client who is looking to invest. So the first step in any journey, basically, for someone who is looking to buy a business or invest funds into an acquisition, is identifying the need for a deal. Now, what or why do mergers happen? What is the reason behind a merger or an acquisition? Why does company basically go into an acquisition mode? Happy to have anyone who is willing to just contribute and share what they think about why a company basically need to get into a acquisition.
So we have a message from Miku to unlock the value. Miku, you can also unmute yourself. If anyone want to, so you can just unmute yourself. I can have a direct conversation. And also, if you have any questions, just raise your hands, and then we can take it from there. Yep. So there is a comment from Miku. Miku saying to unlock the value.
Unlock the value. That's a good one. What else?
I believe, to expand the market.
Market share.
To have a market share, to have a bigger market share, and
Sure.
to expand and to go on to the other field, to diversify their portfolio.
Of course. No,
That
I
could be
think
the
that.
one.
Yeah, I think you rightly pointed out, in responses unlocking value. Let's slightly delve a little more into that. So obviously, a company, when they decide that acquisition is the right step for them as to grow, there could be various reasons for it. One obviously is expanding their market share, getting into a geography where they were not present, and a target company may actually give them that presence. There may be reasons like eliminating competition, and by virtue of doing that, they become the market leader in that particular space. In some cases, diversification is also a reason for it. So for example, a company into frozen vegetables basically may actually look to acquire a company into frozen fruits, and that's how they kind of expand their horizon. uh, Synergies. Have you heard of the term synergies? It's a very, very interesting, kind of concept in mergers and acquisitions, which basically means to say that 2 + 2 is not equal to 4. It's definitely greater than that. Now, synergies are achieved, generally through mergers or acquisitions by virtue of having businesses combined, skill sets of employees get combined, higher revenue gets generated by virtue of that. And as I said, I mean, technological advantage or advancements also happen by virtue of companies getting, merged between each other. So very, very important, aspect of this is for any company in today's day and age to go into an expansion journey to really identify why they need to acquire a business or why they need to do an acquisition. So defining a clear strategy is very important, identifying the need, discussing it with their board of directors and getting all the stakeholders involved and getting a buy-in from them before you take that mode is very important. Now, why is that, very, very strategic? Clearly, I mean, we have a lot of examples in history and in recent past as well as to why companies, need to think through, and mergers and acquisition or the need for a merger or an acquisition before they actually embark on that journey. Very recently, you would have, seen the biggest bank in Canada, RBC. They acquired HSBC's Canada operations for $13 billion Canadian dollars. Now, why was that a good deal for RBC? It was a good deal because that gave them an access to global businesses. There are a lot of Chinese companies and Chinese businesses having accounts with HSBC, and they were doing trade, and that gives RBC a competitive edge because they get access to a wider market and wider public, and expand their offerings accordingly. It obviously makes them even bigger. So RBC is the biggest bank, and HSBC, when they were acquired, was the seventh largest bank in Canada. Now, by virtue of this acquisition, RBC's enterprise valuation has gone further up to around $190 billion. Their next best competitor, which is TD Bank, ranks second, but they are way behind. They are $50 billion lower than where RBC is. So clearly, they are, through the acquisition, they're obviously not just generating synergies by virtue of combining, HSBC's operations, but also making sure that by virtue of, the acquisition, they are becoming even bigger than what they are. If you talk about other examples like Facebook, who acquired WhatsApp. So when Facebook acquired WhatsApp in 2014, they acquired it for $21 billion. Now, was WhatsApp really worth it at that time? Was WhatsApp really having that much of subscribers at that time that commanded that big a valuation? Not really. In fact, Facebook actually was competing with Google, who was also looking to acquire WhatsApp. But Facebook actually doubled their, quote. So Google was acquiring it for somewhere around 10 billion, and Facebook actually sweetened the offer. So much so that they went ahead and increased that price by $3 billion again. WhatsApp had 450 million user base at the time when they were acquired. Today, they have a monthly 2 billion active users on their platform. So clearly, when that deal happened, everyone was gung ho about why WhatsApp is being paid so much, and why they command such a high price. But there was a vision, there was a story, and they were strategic enough from Facebook's point of view when they actually embarked on that journey, and they're realizing benefits and they're monetizing it post acquisition. There are various reasons deals fail as well. There can be various not just operational reasons, but there can be reasons which are beyond your control in some cases, which actually restrict a deal to happen. Now, it can be obviously operations, high price being paid. Let's take an example of Nokia's acquisition by Microsoft. Now, we all know Nokia was a very, very huge and very prominent company in the early 2000s when feature phones were with everyone, and they were the largest player in the market. Clearly, they did not adapt according to the market situation when iPhone was launched and then Android came over. Nokia continued to, just rely on their focus and strategy on, going with feature phones. And they realized very quickly that it was too late for them. And that's when Microsoft came in. Now, Microsoft, obviously, when they got into that business, they paid around $7 billion to acquire Nokia. Their thought process was, by virtue of this acquisition, and because Nokia has a very big customer base still, they can basically launch another OS, a window-based OS, and they would be able to generate synergies from Nokia's hand phone operations, and they would have access to that, and their technology will feature on their phones. But clearly, the merger did not happen because of various reasons. One was the employees could not, the alignment of the employees post the acquisition did not happen. The culture of Microsoft did not actually resonated with Nokia's employees, and Nokia still was, kind of a laggard in its space, which Microsoft tried but could not convert. Now, as a result, 2 years later than the acquisition, um, the deal did not, fructify, and Nokia was sold uh, back by Microsoft. Clearly, I mean, there are various reasons. Another example I'll give you, very interesting one, is Broadcom, which was a telecom, provider based out of Singapore, was looking to acquire Qualcomm. Now, Qualcomm basically is a company which is into 5G technology in the US. During 2018, they were being acquired for over $100 billion by Broadcom, but the deal was blocked by the US, citing national security reasons. Now, that national security reasons was the fact that US feared that having Broadcom play into the US markets will lead to less research and development on 5G front, and they will lose competitive advantage to China, who is building 5G technology through Huawei communication. So the deal did not fructify. So all in all, what I want to just mention is there has to be very, very clearly laid out strategy before a client basically looks to get into a mergers and acquisition mode. And as a result, the next step there is looking at which players are available or available for sale in the market. So basically, looking at the players in the market, that is a target listing, and doing an industry analysis and a company analysis to see where the industry is going and where those targets basically that they are looking to acquire are featuring in terms of revenue, in terms of growth, in terms of operations, technology, and various other fronts. How do you, determine who is available to sell or which businesses are available to sell? There can be various modes to it. One mode is a lot of companies basically have their in-house teams who will do that work, do that research on a day-to-day basis, identify the potential targets, and then zero in on a particular target that they want to go ahead and acquire.
So Kapil,
Yes, please.
so there is a comment from Miku, and there is a question. He
Sure.
want to see if you can shed some light on 7-Eleven probable deal as well. Like we can keep it for the last as well, but like you are
So,
driving it, so just see like wherever it fits well. But yes, there was a question. If you can shed some light on 7-Eleven deal, but that was the thing.
okay.
Okay, thank you. You can take it from here.
Thank you. So I'm not privy to the 7-Eleven deal, but I'll, because we are having two sessions, maybe I can cover that question in the next one when I have researched about it slightly more in detail. But thank you for the question. I'll note it down. So yeah, I was, just of the view that one is you have in-house teams basically doing that work for you. And in many cases, companies hire investment bankers or financial advisors to do that job. You would have heard of companies like JP Morgan, Goldman Sachs, various other companies which basically do, basically find prospective sellers for buyers, and they do the matching for them and manage the whole process. Their sole interest basically is to act as a mediator and make sure that the deal goes through and it's a successful kind of transaction for them. And in exchange, obviously, they take a fee, which is a commission on success of the transaction. So there are various, service providers that you can use to basically go about that journey. Now that you have, gone about, discussing. Okay, I'm just trying to move to the next. So now that you've, kind of got a, set of potential targets, and company just does not always work with one target. They may have multiple targets and then they zero in on one. I see Sumit has raised his hand. Why don't you unmute and ask your question, Sumit?
Yeah, thank you, Kapil. Kapil, just on the previous point where you said that there could be in-house teams as well as there could be iBankers. But other than these two channels, are there other driving forces which drive M&A in the space? Like, for example, is there a role played by Big Fours or their advisory teams, or let's say management consultants like McKinsey management consultants, etc., McKinsey and company and all? So are there other
Yeah.
participants also which drive these type of deal flow? And at what stage do they come in? Is it more solicit or unsolicited advisory that comes to the company? Let's say Walmart or Costco or just any big name, and some external advisor approaches them and says that, okay, you could be doing well if you maybe acquire company B. So is it like solicited, unsolicited, and what are other participants in the market who are involved
Yeah.
in this?
Yeah, so financial advisors basically, while I mentioned about, these big names, financial advisors basically can be even big four firms. But what I've noticed generally is that because of various things that get associated with the M&A, and there are legal, parts of activities as well. So sometimes some of the portions of a deal basically are outsourced to specialists, and it becomes a joint operation of sorts. So you may have a big four investment banking team basically doing the sourcing. They may actually be working with other service providers as well along the way to actually help a particular client do the deal as part of a consortium. So it's not just those investment bankers. There are brokers as well for smaller deals. You do not need to go to investment bankers. Brokers basically will find you targets who are available in a particular market, and you just liaise with those brokers. And sometimes those brokers have advanced teams as well to actually help you through the whole process, which includes they liaising with various parties who may come in to do financial due diligence, tax, and valuation, and similarly draft the legal an SPA or sale and purchase agreement to help close the deal um, um, in aggregate. So it's not just one party, but there are sometimes multiple parties that are involved.
Got it. No, that's helpful, Kapil. And I understand that during the course of the presentation, you will cover, let's say, what the roles of Big Fours are, because I have seen Big Fours having some deal advisory teams and valuations teams and all those things. So just wanted to
Absolutely.
fix it. Yeah, cool.
Absolutely.
Thank you so much, Kapil. Thank you.
No worries. So, okay, perfect. So now, in the planning phase of it, a lot of times sellers basically have a vendor due diligence done through a consulting firm or a third party service provider that basically gets circulated to potential buyers in the market. In many cases, a SIM is provided. A SIM basically is a confidential information memorandum. That basically is a document that describes the business of a seller, which industry that it operates in, what is the revenue, what are the financial statements looking like, and what are the projections looking like for that business. Now, these documents basically get shared with the buyers under an NDA, which is called a non-disclosure agreement. Basically, an agreement between potential parties who are getting into a potential transaction, to basically say that they will not be sharing that information or disclosing that they are into conversations with anyone else that during that particular time frame. Once you are under an NDA, those documents basically come to the buyers to do their evaluation. And based on all the high level information that is provided, they basically come to do an indicative valuation of the business, basically, which can be into a range or it can sometimes be a fixed value that they determine. Now, I'll go to the next slide to just quickly talk about this valuation and what are the modes of valuation for companies. So enterprise value basically, or the indicative valuation to start with, basically can be done or determined through two prominent methods. One is the discounted cash flow technique, and the second is the price earning multiple, which is PE multiple. Now, discounted cash flow on a very simplistic basis is looking at today's cash flows and predicting those cash flows, applying a discount rate of how they would look like in the future. And that becomes the base for the valuation of a company. Obviously, cash flows need EBITDA, and the base for cash flows is again the profitability of the business, and the underlying factor that is used is EBITDA, which is a proxy of cash flow. Price earning multiple is basically looking at the same EBITDA that the company has generated and applying a certain multiple. So, for example, a company has an EBITDA of 1 million. And in that particular industry, based on previous deals and experience of previous deals, their deals basically happened at 5 times the EBITDA, which means that this entity will be valued 1 million times 5, which is $5 million is their enterprise value. So these are the two, commonly used techniques in a mergers and acquisition scenario to determine the indicative valuation of the business. Now I'll come back to the previous slide, and I see Sumit has raised a hand. Sumit, please go ahead.
Yeah,
I'm liking that people are asking questions. Thank you.
Yeah, Kapil, thank you so much for offering the opportunity. The EBITDA, like I've heard and I've read many times that when they talk about EBITDA, they also talk about sustainable EBITDA. So even some job postings, I say that, they mention looking at sustainable earnings and EBITDA. So is there specific adjustments to EBITDA which you do, like company report EBITDA, you add DNA, you get EBITDA, but then are there specific adjustments with regards to valuation that people do? Well, they say sustainable EBITDA.
Absolutely. And that's something that I will cover in the next step, Sumit. So you will just hold yourself for a bit, and we'll reveal that as well.
Awesome. Thank you.
Okay, so now that once you have got an indicative valuation of the business, the next step is to prepare for a bid and submit an indication of interest or a letter of interest. So an indication of interest basically is a document which is on a very high level, a non-binding document which contains certain terms of the deals. Who are the parties which are involved, the buyer detail, the seller's detail, what is the preliminary purchase price, which can be a range in case of a IUI. It can basically say the business will be targeted to be purchased between $30 million and $35 million. It will have potential clauses on how the deal will be sourced, what will be the structure of the deal, and so on and so forth. That's basically a first step, particularly when businesses are being sold on an auction. So if there are multiple parties which are bidding for a particular seller, they would invite indication of interest, and the seller basically gets to determine who is the best, possible buyer that they want to go ahead with, based on their size, based on their perception on how they can run their business and grow the business post the sale. And once they determine a certain buyer, the next step is to invite letter of interest. Now, the letter of interest becomes slightly binding because now in a letter of interest, it's like a term sheet which will have final purchase price of the business. It will basically be laying out, what all is being bought and sold, what was how the transaction will be structured very, very clearly, whether it's an equity deal, how are the financings going to be, arranged by the buyer to be able to do the deal. It will also have a clause on a particular deposit, deposit amount that may be deposited with a escrow account, which will be managed by the investment bankers, which means that if a deal is being acquired for $5 million, they may ask for $30,000 to be deposited in an escrow account to, basically say they are very serious about the deal and there is intent to buy. And subject to due diligence, that particular deposit may be forfeited if the buyer do not convey their serious interest or their potential negotiating points before a certain point which is described in that particular deal in the exclusivity period. So what is an exclusivity period? Exclusivity period is determined in LOI or defined in an LOI, which says that during the period when you are engaging, a buyer is engaging with a seller, the seller will not be engaging with any other buyer for that particular period. And that exclusivity may range anywhere from 30 days to 90 days. Obviously, the buyer would want more exclusivity period so that they get more time to do the due diligence and find any red flags in the deal and be able to take more informed decisions. And for that, obviously, they need time. From a seller's perspective, they would want that to be slightly lower because they would want to close the deal and they really want to go ahead with the transaction. And the more time basically also means that they are into the market and there is risk that the information become public and it hampers the deal. So once all these activities are done, you have a bid, LOIs in place. The next step is the evaluation phase, and that's where basically when Sumit you asked that question, that is the point where the initial purchase price or the indicative valuation that I talked about earlier gets to get adjusted through the findings that come during the evaluation process by the buyer or their financial advisors. Now, what basically is happening in the evaluation phase is now that you are into an exclusivity with a particular seller, you arrange as a buyer basically lines up various service providers who will come in to do very, very specific parts of work in assessing and evaluating the target's operation or the seller's operations from various vantage points. It can be financial due diligence, tax due diligence, legal people coming in to do their legal, commercial due diligence, HR, IT, and various others. Now, what is a financial due diligence? Let's start with that. Anyone who want to just talk about what their understanding is for a financial due diligence? Or maybe what is a due diligence? A very dictionary meaning of the term due diligence.
If anyone want to unmute themselves, Sumit.
Yeah, I think from a broader perspective, I've not been involved. I'm on the actually investment side. So for us, diligence means like thoroughly understanding that wherever we are putting in money, we have thoroughly looked at all aspects of risks that exist in that particular investment. So I've not done, for example, tax diligence. We just do financial due diligence. But that's what I understand, that you look at it in totality, that you're not leaving any stone unturned before you take a final decision to put money.
Yeah. So rightly
Yeah.
said.
Sorry, yeah, I'd like to add to that. Maybe have some compliance checks, and the numbers that are quoted are pretty much accurate and they're true. So I think that those are the couple of things I'd like to add there.
Thank you. No, I think all valid points. What I would just say is due diligence, in its very simplistic terms, is all the activities that you would do as a buyer to make yourself comfortable with what you are getting into. For example, as an investor or a buyer, you are looking to buy a second-hand car from a seller. Clearly, that second-hand car, or even a new car for that example, if you're buying a car, you would need to know and define what is the model, what is the make of the car, how much does it cost, and for that matter, if I'm buying it from some other party, is there any debt or lien on that particular car, any encumbrances on that car that I need to be aware of, or that the seller basically needs to settle before I actually buy it. How much will it take to basically perform repairs? How much fuel does that car has? All those things basically you would want to get comfortable with, and for that you do a due diligence. Now, applying financial as a prefix to the due diligence, what you are then looking at is, if you're looking at acquiring a company, you are looking at the historical financial statements of that business, how the business has been run, what are the drivers of revenue, profitability, working capital, how's the balance sheet looking like. And based on all those parameters, you would want to know if there are any potential events that have happened in the historical operation of the business, which may or may not continue when you acquire that company. And you would obviously want to adjust for those from the reported EBITDA of the business to determine the underlying earnings or the sustainable earnings of that company. Now, that bridge basically is what comes as key issues or a quality of earnings assessment in a due diligence report that service providers would basically give to you. And that may sometimes become the base to adjust the purchase price of the company, which was initially agreed. And we'll come to that. So similar to financial due diligence, there is a tax due diligence, which basically talks about making sure that tax returns, the company, the seller basically is compliant on the tax side of it. Returns are being filed, taxes are being paid. There are no litigations, or if there are any litigations, they are known, and the outcome of that is something that the parties are aware of. Legal due diligence, again, looking at corporate matters, corporate filing, compliances, regulatory, and sometime during the phase, A legal due diligence also means lawyers will come in to help with drafting of the SPA, which is sale and purchase agreement, and that's a very important part of executing a deal, and we'll come to that slightly in the next phase. A commercial diligence. I'll tell you from my experience. I was looking at a company which was a non-banking financial company, which was extending, loans on renewable energy projects. Now, apart from doing a financial due diligence, the client basically wanted to know what is the status of each project that they are into, what is the internal rate of return, or what is the profitability of those projects that they are into, and they wanted a commercial due diligence in that. So it becomes slightly more strategic, looking into not just the financials, but also looking at each project and splitting that DD into various pieces to give the client a view on, much beyond just the financial aspect of things. HRDD. HRDD sometimes is very, very important where, human resource companies basically are acquired, or companies with, huge volume of human resources are basically part of sale and purchase. Why it is important is because it gives you potential synergies that may be achieved by virtue of this acquisition that the client will be looking to undertake, because they may have a skill set that may be existing and they may not really require a certain set of employees, or they may want to repurpose certain employees to other areas of business to maximize and optimize the value of the acquisition, and making sure that they are generating the synergies that they expected by virtue of that acquisition. Similarly, IT due diligence basically takes care of various technologies that may actually have synergies. So a client may be on Oracle, and the target basically may be using QuickBooks, or maybe using some other software, and they would want to give or quantify the impact of merging the systems by virtue of this deal, and whether there are any savings that can be brought about by combining the systems and just getting rid of the system which is not required going forward. That leads to cost savings as well. So all these due diligences basically culminate into revisiting the valuation of a business. And I will just quickly go to the next slide here and basically talk about the purchase price mechanism. Now, to determine a purchase price, there are two commonly used methods, and the most prominent method is using completion accounts. The other prominent method is lockbox, and the lockbox basically is more prevalent in the European markets. In the North American markets, or even Indian markets for that matter, business or the headline price of a business. In this case, you will see whatever approach you've taken to value, whether it is PE multiple or DCF, the initial price of the company is 1 million, or the enterprise value of the business is 1 million. You do various, and obviously the fact that when a buyer acquires a business, they would want any debt, less of cash in the business to be taken care of by the seller. So any debt in the business, they will not assume. They will expect the seller to basically settle that before the closing happens or before the transaction takes place. And that's why from that enterprise value, you're removing the debt to basically find out the equity portion of the business through the purchase price. So in this example, a company which is valued at 1 million, net of cash and debt, it's 800 million, which is 1 million less the 200 that you see. Now, clearly, if, when you do a due diligence, you're looking at that enterprise value as the base. So for example, for that 1 million, the EBITDA of that company was, say, 500,000, and 2x multiple was applied on it. Now, in the due diligence process, they came up with certain non-recurring events that happened, or certain accounting adjustments happened, which reduced the EBITDA to 450,000. What it means is now that business will be 450,000 times 2, which is 900,000. So which means that the purchase price, which was 800,000 earlier, which is 1,000 minus 200, is now 900 minus 200, which is 700,000, which is an adjustment that will be demanded by the buyer, or which will be a subject of negotiation when the deal goes to the next phase. So that's one aspect of it. There are various other factors that may require adjustment to the purchase price. Now, clearly, when you're buying a business, for example, we take the same example of a car. If you're buying a car, you're not just buying the car and operating it without any fuel in it. So the fuel is like a working capital for that car. So assume that for that enterprise value of 900,000 for that, but 1 million for that car, there was 100,000 of working capital in it, or there was 100,000 of fuel that was required in that particular car for a particular year. Very simplistic. And at the time when actually the deal was closing, they determined and they saw that the fuel tank was worth only 50. So clearly, they are not getting the full 100 for that working capital, but they are getting only 50, which means that when I take over the car, I will have to refuel the car to the extent of the differential of 50 to make sure that I'm able to run that car or as agreed. So I will demand, the buyer basically will demand an adjustment to the purchase price to the extent of that 50 for the fuel component of it, which basically means the working capital required to run that business, or the differential of working capital that is required to run that business. And that's the working capital adjustment you see there. Now, during due diligence, you noted that the tires of that car basically were very old. And, post acquisition, you determined that the buyer would not be able to run the car beyond, 1 or 2 months. Now, clearly, the car has been run for many years, and they haven't done the replacement of the vehicles which were due. As a part of the negotiation, I would basically, as a buyer, negotiate for the replacement cost of that car's tires to be adjusted from the purchase price. And that's what that 20 that you see shows in that table. And that's how the net purchase price basically gets computed in an acquisition. And that's basically a completion mechanism, which means that when you have initially determined a purchase price, which is 1 million, the sell and purchase agreement basically gets executed on that 1 million. And that 1 million basically gets transferred, subject to any adjustments of working capital, capex, and various other things that may be revealed when the deal is actually being computed, it's being consummated. So that adjustment happens sometime later than the sale and purchase agreement is drafted, and that's all documented in the SPA. And we'll come to that now again. So final negotiation and closing, I think we discussed that part. Once you have, Sumit, go ahead. You have a question, I guess.
Kapil, a very, slightly off track maybe, but I've heard, and this is just what I've heard from people, that there's something also called operational due diligence, where there's a site visit and people, from the acquiring company visit the place and see if it is actually on, like on paper, it all's okay. But then if you visit there, the factory is still there and everything. Right. So is that part of just public market deals, or that is very specific to, let's say, private equity type of due diligence activities?
No, an operational or a commercial due diligence basically sometimes are used interchangeably. And that is not something which is only privy to a public, company deal. Even for private companies, a site visit and looking at the operations on ground is something which is a very, very common aspect of it. And at any point, what happens as part of the LOI is when you're documenting the LOI, there is a clause in the LOI saying that the buyer will be entitled to do due diligences, and they define the number of times they can visit the factory or the site of the company to do the due diligence process or get comfort on the on-site operations. So that's also something which is defined sometimes very, very explicitly in the LOI, and that gets done. Not
Got it.
every company basically does that, but clearly the owners are interested in doing that.
Got it. Thank you so much, Kapil.
No problems. Okay, so we covered the negotiation part of it already. I'll just quickly delve on the SPA signing. What is basically an SPA? A sale and purchase agreement or an SPA is a document that defines all the aspects of a deal in a very, very specific and precise document, which is drafted by the counsel, the legal counsel, which is helping the buyer and seller from either side, and reviewed by both parties, and signed upon, because that becomes a binding document. A sale and purchase agreement has the purchase price, the final purchase price, the adjustment mechanism to the purchase price. It will have very specifically laid out definitions on what all is being acquired and what all is not being acquired. So basically inclusions in a deal and exclusions from a deal. So in many cases, purchase price basically is determined based on only the assets that are being acquired. So it's not an equity deal. It's not a stock purchase agreement. It's basically itemized purchase of assets or sale of assets. So in that case, you will need to define in the SPA which assets exactly are being part of the acquisition and which assets are not being acquired or which liabilities are not part of the deal. So it needs to be very, very specific. It will also basically have warranties and indemnities from the sellers documented very, very clearly. What are warranties and indemnities? I'll just quickly, spend a few minutes on that. A warranty basically is like a statement or a representation by the seller that generally they have been compliant in various aspects or the running of the business. For example, accounts are being prepared yearly, taxes are being filed regularly, they are being paid on time. So basically, if there is a breach of any warranty, which basically was given by virtue of inclusion in the SPA, a buyer at a later time basically can hold the seller responsible that they were in breach of warranty because taxes were not filed. And for whatever reason, it got revealed later, they will demand the seller to compensate the buyer for that loss. Similarly, an indemnity, it's not a statement. It's a very, very factual kind of assurance that is given in the form of indemnity, saying that for a particular liability that is basically that a business is subject to. Say, for example, there is a tax litigation that is going on, and that is in court right now. The business is being acquired when the litigation is still not finalized. The outcome of that litigation, whether it will result in a liability that is to be paid or a compensation or fine that is to be paid by the party, is not certain. How much will that amount be is not close because it's going on with the court. Now, that indemnity basically will say that if that litigation results in a liability or a fine that is to be paid by the company, that will be borne directly by the seller. It will not be borne by the buyer because it resulted from operations or at the time when the operations were run by the seller. And that is basically an indemnity. So the buyer, will really want to make sure that their due diligence is very, very intact. It's very thorough, and it is giving them all the possible red flags that needs to be documented in the SPA, because beyond the SPA, they do not have any, opportunity to go back to the seller if they miss something and pay a price which is not worth the business, and they would want to make sure that that doesn't happen. So that basically is an SPA. Once you have signed the deal, clearly, it goes to closing. A closing set of financial statements are prepared. Say, for example, your due diligence was done at 31st of July, and the enterprise value or the purchase price was defined at that time. It was finalized, but you are acquiring the business, or you are actually starting the operations under your umbrella from 1st of November. Now, what the parties basically will do is on 31st of October, they will request the seller to prepare a closing set of financial statements. And it can actually be before the deal. It can even be 30th November when they have acquired the business and it's 1 month past that. But whoever is more suitable to do the closing accounts will do that, and that's agreed upon. At the time of the closing, if there are any changes in the way the business has been run, or if the working capital has changed that I talked about earlier, if there is, there is cash that is being taken out beyond the ordinary course of business, all those basically will become subject of an adjustment to the purchase price. And we covered that earlier, but I'm just trying to put some dates to that. And once that is done, the remaining purchase price or adjustment basically is transferred, and the deal is concluded. Now, the deal doesn't just get closed once you have acquired the business. There are various activities that happen even post the deal to make sure that on day one, the business that is being transferred, or the two businesses that are being merged, are run as smoothly as they were, and there is no disruption to the business. There is no impact to the customers who are who do not know about the deal any which ways. There is no impact from a point of view of employees who are basically now going to work under a common umbrella, or sometimes basically work under a new arrangement or new potential employment clauses. So all that communication, starts happening, through the evaluation and through the closing phase itself. A buyer basically wants, most of the times, the buyer basically would request the seller to introduce them to the customers, to the suppliers. Sometimes that can happen, during the, evaluation and closing phase. Sometimes, that can happen even post the deal. So they will reserve a time, which is generally 3 months, or, 3 to 5 months post the deal, to make sure all these interactions are happening and there is clear communication to all the stakeholders involved, so that there is no disruption in the business. And clearly, obviously, once the businesses are combined, preparation of consolidated financials apart from standalone financials also is a factor that is new to the two businesses, and they need to view the business and various KPIs from the business on a consolidated basis. Preparation of consolidated financials comes into picture. Now, this is, all the set of activities that happen on the buy side of it. I know that, I mentioned earlier that a lot of you would, who are intrigued to know more about the process are more informed about it, but would also want to know what roles exist and where in each step of this journey can career be built in an M&A profile. So with that in mind, I've just set up the potential areas or roles in each stage of M&A activity at the bottom of this page. And at the first step, obviously, when the client is actually in a mode where they are determining or identifying the need of a deal, that's where the investment bankers or roles like research or corporate finance basically comes into picture, because buyers would want to liaise with consultants early in the process, and they would want as much information as possible before they actually get into a serious mode of discussions with potential seller. So as we move to the planning, evaluation, final negotiation phase, various profiles, various roles come into a picture, like financial due diligence, tax, legal. Clearly, if you're doing all of it, then the investment banking role, strategy teams basically come in. I think someone earlier talked about where does consulting firms like McKinsey, Bain, Boston Consulting comes into picture. The commercial due diligence aspect of it, operational, etc. Even if it's not uh, in deal process evaluation, but even for pre-deal, sometimes the client basically engage consulting firms or management consulting firms to determine whether an acquisition is the right approach for them, or basically they can grow the business organically. So a consultant's role doesn't just get under the scope only when a deal is in existence. It can also be a pre-deal or even a post-deal kind of scenario where consultants come in. And obviously, for valuations, you need valuation experts to do that work. Once the deal is closed, and sometimes throughout the process, accounting is very common because you are looking at financial statements, and accounts basically are the base of it. So post the deal, when you're preparing consolidated financials or looking at various aspects of merging two companies, technical accounting rules come into picture. Say, for example, a US company is taking over a European company. The US company obviously is maintaining books under US GAAP. Target company, which is based in say Finland, is basically using euros, and they are into IFRS. Now, what it takes to actually merge, the two businesses, and what all will be the impact on accounting and financial reporting due to that particular combination of two separate gap following gap adopting companies. That's where technical accounting roles come into picture. Integration and separation consultants, again, a lot of management consulting firms do that work, help them with day one preparation readiness, day 100 preparation readiness, basically defining roles by each function as to what HR roles will be, what IT roles will be, how will the transition be happening on the financial side of it, various aspects of it, integration and separation teams of not just big four consulting firm, boutique consulting firms, and even management consulting firms come into picture. So, and for all these roles, because financial evaluation of companies is not in the nature of an audit, you do not necessarily all the time need to have a CPA equivalent degree to do these roles. A MBA or a CFA, chartered accountant, even sometimes graduates basically get into these roles and grow into those profiles. Obviously, having a CPA, a chartered accountant helps, but because the very nature of M&A is not mandated by a statute or a regulatory body, it's fine to basically explore these roles, get into it, and then basically achieve the qualifications that you are that you think is best fit for the particular niche, because every role is a niche of its own. And that's pretty much it here from my side. Any questions? You can, I think there are more than one hands raised, so please feel free to go one by one.
Hi, Kapil. This is Parth. Great session, very informative. I'm with BDC, and I work with a lot of consulting firms, and we get businesses for M&A financing. In particularly your firm, and sorry, this has nothing to do with the session. We can also take it offline if you'd like. I just want to understand the kind of services that your firm would provide, where we have clients, and what is the right space that your firm operates in, any particular deal which might be too, small for you or too large for you.
Yeah, I think that's something that we can definitely cover offline. But yes, I basically, do mergers and acquisitions, particularly on the financial due diligence side of it. And apart from that, the management consulting aspect of it. And by virtue of that, obviously, we engage with a lot of financing institutions as well, because a lot of times clients basically are looking for acquisition depth to go about their transactions. And that's where I liaise with the, companies or financing institutions like you. So we can have a conversation, definitely a more broader conversation offline if that works. And I have my contact details here for your reference.
So not a problem. I'll reach out to you sometime next week.
Thank you. So Miko, I think you have a question.
Yeah, thanks, Kapil. Can't thank you enough for this wonderful session. I love the examples. Once again, I'm kind of coming back to that one. Love the examples that you shared at the start. And I was wondering what kind of sources you refer to keep on track with the kind of deals that are happening, maybe in Canada or the US as well.
Yeah, I think if you read any financial news, merger market, has deals that are featured. There are various other tools. Even if you go ahead with mergers market, there is Yahoo Finance and various other basic sources, and then based on networking, you get to know about some of these aspects of it. But yeah, I think there is enough material in common parlance that you can search for to get to know about it. Even if you look at Google and M&A news there, they will feature um, latest there. So yeah, those are my sources. No specific sources, to be honest, that I cater to.
Sure, thank you. And I just had one quick follow-up on that one. You mentioned the financial due diligence part of it. So would you be working on any sort of financial models to maybe create your own for the clients that you're working with?
Yeah. So a lot of times, models come to us for a review, and we assess those models from a reasonability perspective, whether they are too aggressive or too conservative. So by virtue of looking at those models, we provide advice on the targets assumptions on the future projections. And yes, by virtue of that, we look at it. So happy to have a conversation there. I don't prepare models, by the way. So I am not an expert in modeling, but yes, I have knowledge of reviewing them.
Awesome. And would these be typically Excel-based financial models, or with advent of technology, there are more tools that are now getting in picture as well?
I think the base is Excel, but you use various power tools to slice and dice and kind of to come up with the more effective ways of handling large data to build those.
Awesome. Thank you so much.
I had a quick question, Kapil, if I can ask.
Please go ahead.
Okay. First of all, thank you so much for the session today. I was not expecting to go a lot into technicals out of it, especially the modeling. Thank you for beating my expectations. One quick question here is that, like sometimes, let's say you want to do like a company analysis or like an analysis of your competitors in the market, see where your company stands when an M&A deal is happening. Do you think that sometimes when the extent is kind of small, you don't have access to a lot of data about final accounts of other companies? Let's say a big deal is happening, the .com and the Qualcomm, you could just go to Yahoo Finance and get the data. But let's say a market is like very small, kind of. Do you think that sometimes that becomes a barrier when you don't have access to like financial data of other companies in the market to do like a comparison where this company lies, like your target
Yeah.
acquiring?
Yes, absolutely. That's a big challenge for private companies where data is not available readily. So in many cases, the initial kind of evaluation of the business is on a high level based on whatever seller has provided, and that's basic tax returns and basic financial statements that come to us, based on which a buyer gets into a LOI. But then once they are into an LOI, and as I mentioned, it needs to be specifically, kind of covering the aspect that the LOI is subject to a due diligence, and based on the outcomes of a due diligence, so there may be a go or no go or an adjustment to the purchase price, which will be negotiated for. That's where we kind of get into the nitty-gritties of it and be able to provide better insights on the real the real worth of the business, or the key factors that the buyer needs to look at when they go about the deal.
Got it. That clarifies it. Thank you so much.
Yes, I can
So
share the presentation. I see there is a message, and
from Abhishek, yeah. Okay.
yeah.
So any other questions? Okay, awesome. So thank you everyone.
Perfect.
Thank you for joining on Sunday, and thank you, Kapil.